live. Hello, everybody. Wait for a few people to get online. How are we looking? I get a thumbs up from the director, producer, love of my life.
No.
Yes. Hello, everybody. Housing Debrief episode 46. Something like that. It's getting up there. Anyway, let's go ahead and begin. And today we do have happy hour Q&A at the end of this. So let's get started. Stephen Thomas with, my background is quantitative economics and decision sciences major from UC San Diego. 29 years in the business, Orange County native, Capitol Valley High School grad, 9 kids. That's right, 9 kids. I'm an avid runner. And I brought 6, my wife brought 2. I adopted her, she adopted mine. We had a bonus guy, Zeke, who woke up in the background.
Okay.
And I've been in the press, and our company is Reports on Housing. It's your local real estate snapshot. It's really about driving down locally as to what is going on in the marketplace. Not so much about closed sales data. I mean, we do include closed sales data, but that's not, I don't really talk about it that much in my reports. There's a chart for that, but the reason I don't is because it's a reflection of the past. August, we had August closed sales. That's a reflection of June and July. Later on this month, we'll get September, but that'll be a reflection of July and August. I want to know what's going on today. We're in October. This is October. We're in the 4th quarter of 2020. So what's going on in the 4th quarter of 2020? We look down the out down the road, out our windshield, and we're looking at the supply and demand. Active inventory and demand is the last 30 days worth of pending sales. And from that gets you the true velocity, speed of the market, the expected market time. How quickly are you going to open up escrow if you place your home on the market today? And there are different metrics that we follow besides the macro county. It's down to the area and the city. And then we drill it down to price ranges as well as detached versus attached. And we focus on one big topic. So how I speak is how I write, and I talk about the market and illustrate it through data and statistics. It's all about setting expectations of all of us, buyers, sellers, clients, ourselves. And we have reports that dot all over Southern California, LA, Orange County, Riverside, San Bernardino, and San Diego. And Orange County's been around since 2004, and the others have been around since last year. But I have data going back to 2012 on all the different counties at the county level. So the most recent one came out this week, Monday, and it was powerful, strong, resilient. I talk about how powerful the market is. It's very hard to put a handle on why are we at such a fantastic pace given the time of year. We're already in October. And I give the example of a lighthouse, and it's powerful, strong, resilient. It's kind of like you can throw everything at it, big waves, and yet they stand for centuries. And that's kind of like the way that this year has been for real estate. So that's the most recent one. San Bernardino and Riverside's, theirs comes out on Monday, this strong and powerful, strong, resilient. So you go to reportsonhousing.com, REPORTS on housing.com, and you click on subscribe, and comes out every 2 weeks, and there's a whole bunch of links at the bottom of all the reports. There's one for printing out, copy, cut, edit, paste. There's excerpts for public facing social media, websites, blogs, and then lots of charts. And it's $15 per month or $150 per year, and you get a month free if you use the coupon code TRENDS, because that's what we're talking about today, trends. I'd like to thank our sponsor of today's episode of the Housing Debrief. And it is the Escrow Junction. So Escrow Junction, you can see them at escrowjunction.com, and they can be reached at 760-245-1966. They are, when working with an independent escrow company, there is a difference. So just know that. They've been serving the high desert and surrounding areas since 1986. I was finishing up high school at the time, and they're all over, like I said, the high desert and surrounding areas from Adelano to Wrightwood and everything in between. My grandparents had a house on Victor Valley Lake in Spring Valley Lake, I think is what it's called, Victor Valley Lake in Victorville. So I am very familiar with high desert and loved it as a kid. What's the difference? Escrow Junction is independently owned and operated. They're not broker owned or title owned. They're truly a neutral third party. They have an escrow license and bonding requirements to operate, and they are regulated by the Department of Business Oversight, not the Department of Real Estate, and the Department of Justice investigation. Photos, fingerprints are required for all employees. Know that your funds are safe and secure with Escrow Junction. And they specialize in everything: sales, refinances, mobile home escrows, new construction draws, vacant land sales, 1031 tax exchange. And this is their magazine. They sent me a couple copies. Absolutely love it. It's Exploring the High Desert. Kind of looks like that, doesn't it? But this thing is chock full of information. I went through this, and if you're moving to the high desert, there's nothing better than this magazine. And even if you live there, what a great resource. So you can go there for school district information, recreation information, and just food, shopping, family, and solo activities. Lots of good information. So I have links that will stick on our thread, and you can get a copy of this from Escrow Junction. So thanks again, Escrow Junction.
I think the kids want to say hi.
Oh yes, kids. Yes. I have, you had Hat Day and Crazy Sock Day, right? And we always have Wear a Mask Day. And, no, don't go there. We can see you. We can see you. Don't, she's saying, just come over here. Get on your tippy toes. We'll have to get you guys stools. There's Athena, and there's Mason. We've got 4th and 5th graders in the house. 5th grade right here with Athena, and 4th grade back here, Mason. Anything to say other than those big smiles?
Wear your mask.
Excellent piece of advice. Thank you. Alrighty. Now we have some autumn or fall fun photos. I couldn't call it autumn fun photos. That doesn't sound good. Fall fun photos. Social distance trick-or-treating. I'm liking the creativity. Don't you think? Put the little basket right here, chunk, and out comes the candy. Brilliant. Mm-hmm. The 2 types of people during quarantine. I'm taking this time to better myself. I just ate carrot cake with my hands. Guilty. Best time ever to get braces. This is the best orthodontics billboard I think ever. Our freshman has braces, but they're right. This is a really good time to have braces. Your mouth is totally covered up. I had to show my wife the photo I took, as she didn't believe me when I told her I saw a unicorn today. I should have given you a warning first. I apologize. That's some good stuff right there. Coming up next in 2020. Remember, we still haven't even got to the snow yet. The Southern California market. Yes, powerful. It is strong. And what season is this? I had a hard time putting my finger on exactly what season it is. I'll do my best just following demand, but as far as the expected market time, we're all the way in October, and we're at a very, very elevated pace. You could kind of call it spring, but I want to call it the season of 2020. It's just a different year completely. It's very hard to put your finger on exactly where we're at, but we're at a very rapid pace for housing, and it's nationally. It's not just here in Southern California. As far as the Southern California housing supply is concerned, the active listing inventory year over year, this is where we're at right now, or actually as of a week ago, And that week ago, we were at 25,586. It was down 17 homes in 2 weeks. And last year, we were at 41,413. That's 62% more homes on the market than where we are today. And there's a lot of people that say we have an inventory problem. That's not necessarily the case. And I'm going to show you that later in the number of homes that have come on the market. So it's not an inventory problem. We have this extremely rapid demand that we're dealing with. So, and actually last year at this time, so we went down 17 homes in 2 weeks right here. And last year, this is normal, we went down 2% during a 2-week period. And hey, do you want to say hi?
Sure.
Wait, really quick. Today we're at 25,701. That's up 0.4%. So it's up slightly. Say hello.
Hello.
You're not even in the camera shot.
Well, because I don't want to block
Oh,
that.
that's okay. They can get back to it. This is Alana Jo. She is back from the 7th grade, right?
Yeah.
We have a weekend. Bum, bum, bum. Alrighty. Thank you for joining us, Alana
Okay.
Jo. So anyways, today we're up 0.4%. So it's been relatively flat, even increased slightly during this time period. Normally during this time period, we're starting to come down. This is normal. So we'll have to stay tuned to see if that's really what happens. I have my guesses. We'll get into the different trends that we're seeing momentarily. And as far as the active listing inventory is concerned, this is where we are right now. And if you draw a line across, which I will, the last time it was this low was in 2013. So we have a very low inventory. But as far as this month is concerned, it's the lowest active inventory since 2013. As far as the month of October, it's the lowest active inventory going all the way back to 2012. And if you look at this, we're probably going to go up slightly, I believe, and it might last all the way to Thanksgiving because of the number of homes that we're placing on the market right now. And then after we get to Thanksgiving, it will go down. And so the Southern California housing demand, where are we at right now? This is demand. This is where we're at. We're right there, and you can see still extremely elevated. And October 1st, we were at 20,355. That was down 1% in 2 weeks. So you can see it went down slightly. This is not a big giant drop as we normally do during this time of the year. So it's been remaining elevated. Look at it where it was a few years back. This was 2018. And that's when interest rates were on the rise. Last year we were at 15,284, so that was 25% fewer. This is the difference between this year and last year. Today, 20,511. So it actually went up slightly from 2355 to 2511. And if you look, this little chunk right here, I'm going to do this. I actually saw this while I was doing a presentation. I'm going to move this over. And you see where it follows? So this is our normal spring. And instead, our spring was moved over to here, and it's elevated. It's higher than where it was over here. And it remains here. We'll have to see where we go from here, but it looks like it remains here until we get to Thanksgiving and then comes down. That's most likely where we're going to be headed. What we're also experiencing with a slight increase in pending sales, I'm very interested to see if it's going to continue throughout the whole month of October. That is actually normal. And I call this phenomenon October Housing Fest. And the reason for that is there's a lot of families that kind of get back into the throw of things, that they sideline things for a little while their kids got back into school. Now that kids are back in school, they would like to make a move and move during the holidays. Well, the holidays, in order to move during the holidays, you have to open up escrow. Demand increases in the month of October to close in December. So that's why we see this little, it's not every year that we see it, but it looks like we're going to be heading towards October Housing Fest. We'll have to stay tuned for that. As far as the Southern California demand is concerned, you can see where we're at right now. It's very, very elevated. Even though it came down a little bit over the prior 2 weeks, and it's gone up a little bit, 1% in this last week, you draw a line across and it beats all other markets, all springs, the whole entire years. Each one of these is years. This is 2019, 18, 17, 16, 15, 14, 13, 12. So last time it was this high was in 2012, when about 1/3 of all demand were short sales. And short sales didn't necessarily always close. A lot of them fell out and went back in. So this was juiced a little bit. And it's the highest demand since 2012 is what I just said. Expected market time. The expected market time is right here. This is where we're at. and October 1st is at 38 days. It just grew by 1 day in a 2-week period, so it's not going up that fast. Normally there's a slight incline that you see right here. It's not really happening. SoCal last year was at 81 days. And this is the difference between last year and this year, just a totally polar different market. We were at a slight seller's market last year. That's where sellers still get to call more of the shots, but there's not a lot of appreciation. There's not as many multiple offer situations, and it takes a little bit longer to sell, that type of thing. So it's a little bit different of a different kind of a market versus the hot seller's market below 60 days, which is where we're at today. Today we're at 38 days, so nearly the same as there. It's actually slightly, this date is better than that, but it's all decimal points, and I'm not going to show you decimal points. So the expected market time, when I'm talking about that, it's the true speed. It's like how fast are we going? And it's the reverse of a speedometer, because the lower the number, the hotter the market. So there are some communities that have an expected market time of like 14 days, which means that they have only a few homes on the market, and they have so many more in escrow that it actually surpasses the number of homes that are actively on the market. So when that happens, you get to lower than a 30-day expected market time, which is extremely hot. So the expected market time, this is where we are. If we draw a line across, it has never been better than this at how low it is. When you get up here, that's the expected market time's too high. That's where things slow down quite a bit. And when did this happen? This happened when we had 5% interest rates. This happened during the beginning of the pandemic in April. Oh my gosh, we have a special guest. I have to stop immediately. There's a special guest. Come here, I'm gonna hold you. Daddy hold you. No, I want you to jump. 1, 2, 3. Oh, mommy's gonna give you a chocolate? Look at that. No, you can say hi. Look at, do you see yourself right there? Do you see yourself? Can you wave? Oh my gosh, that is the cutest outfit I've ever seen. What are you wearing? What is this? That's colorful. That's very colorful. It's like rainbow, isn't it? Yeah, they look kind of like Skittles or jelly beans. The different colors. That's pretty cool. This is Zeke. Woke up from his nap early. So thank you for joining us, Zeke. Say bye-bye.
Bye-bye.
It's a family affair here at reportsonhousing.com's headquarters. We're all involved. August and September, lowest level since tracking in 2012. Home values, as a result, when you are well below 60 days, it is a hot seller's market and home values are on the rise. And what is causing this? It is interest rates. Interest rates have been really low. And if you look at this right now, 2.87% is where interest rates are. This was the reading as of last Thursday. This is the weekly average mortgage rate as of October 8th. So they've been doing this for 49 years, and this is the second lowest number. 2.86% was the lowest. It's like knocking on the door. Last week was at 2.88. This week's at 2.87. It was at 2.86 a few weeks ago. You could just see where the market's at. So now let's get into the top 5. All right. And I'm going to do this in reverse. My top 5 trends, I actually ranked these in the trend that I'm seeing, and we'll finish off with the number 1 trend that's out there. So number 5, home values. Prices will rise through the end of 2020. And it's at a pretty rapid pace that values are going up right now. What's going on is this. This is the best way for me to describe where we're at. We're over here, all the way over here. This is where we are playing. So this is the most current readings, right? So when I look at this right here was the end of 2018 when we had 5% interest rates. As a matter of fact, it was at its worst possible spot November 1st, the end of October. So right here is the supply of homes was this high, and demand was right here. So when you have this much more supply than demand, there's too much of something. The market slows and takes longer to sell. Buyers don't feel like that they have to move as quickly, and that's because we had higher interest rates. We weren't in a buyer's market. This was actually balanced. The last time we were in a buyer's market, I'd have to show you the Orange County one. That's over here where we were coming down at the beginning of 2012. This one went off the chart and was way, way, way up there. So you can see we're right now dancing right around 50. It was well over 100,000. homes on the market. It's like 140,000 homes on the market for all Southern California is our best read. So, and then this is during the beginning of the pandemic in April. So this was April when we had lockdown protocols and we shut down the economy and we didn't know if we were going to be able to sell real estate for a minute. And everybody was like wondering what was going to go on. So this is actually larger than this. So it wasn't as slow as when we had 5% interest rates, because interest rates were still really low. So there was still activity taking place, but we had less homes on the market. So the market still was hotter here than it was over here. But now, where are we today? If you see this, it's pinching. Demand is so high and the inventory is just a little bit above demand. That's where it is really hot when these numbers start to pinch. And the other time we had that was in 2013. This pinch is actually not as big as this pinch. This pinch, if I pinch it, it's this. You can see it's smaller here than it is here. Barely, but it exceeds 2013. That's the velocity of the current market that we're in right now. All right, number 4. We have closed sales are on the rise. And this was September for all of Southern California. Some markets were a little bit better than other markets, but all of them were positive this last month. This is the first time that we've had year-over-year positive gains across the board, and it created this. So what we have is September 2020, 19,356 closed sales, residential resale. That's up 20% year-over-year. It's the highest level of the year was was September. Now, September 2019 was at 16,138. That's 3,218 fewer. So year to date, we're down 6% or 8,569. But that was just 1 month. So you can see, I really strongly believe we're going to exceed or at least match 2019's numbers in total closed sales across the board. It's elevated for the rest of the year. So September's closed sales, the highest level since, I'm doing this for each, Los Angeles. So September's closed sales was the highest level of closed sales. It beat all others since June of 2018. So it was, why does that say down 11% year over year? Oh, that's the highest, down 11% year over year. I don't know why I have that like that. So Orange County, I don't know why I even have these negative numbers. So of course I went through the whole thing twice and I just don't understand what I was saying. But August 2005, Orange County had the highest number of closed sales since August of 2005. Oh, I know what it is. Gosh, gotta get back to this. We're down for the year 11%. So that's from January 1st to September 30th. And Orange County is only off by 4% year over year. So the whole entire year up to date through September 30th. Riverside County is at June 2017. Did you see that? Orange County, August 2005. That's how strong their closings were. Riverside is the highest closed sales since June 2017. It was down 3%. It's down 3% year over year, January through September 30th. And San Bernardino is the highest sales print in September since June of 2018. It too is down 3% from January to September 30th, year over year. And then we have San Diego County. It's the highest sales print since June of 2017. And it too is down 3%. Year over year from January to September 30th. And the reason why I'm showing you this is all of these will for sure not only beat, but probably exceed closed sales for 2020 over 2019. The only one that's not going to do it is Los Angeles. Los Angeles is kind of doing its own thing, and they're more, the virus hit them a little bit harder than anybody else. They're number one in the country as far as counties are concerned. And excuse me, I think there's a little bit of a flight, so it's slowed down the market a little bit. There's not as much demand in Los Angeles as there is in all the other counties. So I'm wondering if that trend is going to continue to be year over year for quite some time. That's my question for myself. But I do know this, that things are going to slow down come Thanksgiving. So once we get to Thanksgiving, we're going to see demand slow. So we should see a really good print at the end of the year. But then to start off the year, closed sales should be down quite a bit, but not year over year will be positive. Number 3, more homes are coming on the market right now. So there are actually more homes coming on the market. We've created a hole though. We've talked about this before. There are a lot of missing for sale signs from March through about June, and some even all the way through July. So the number of new for sale signs in September compared to September 2019, so September 2020 to September 2019, in Los Angeles, there were 8,508 new for sale signs, and that's up 11% year over year. They've had 3 straight months of positive year over year homes coming on the market. So all those people that are talking about there's not enough homes coming to market, look at Los Angeles. Look at Orange County. 3,677 homes came on the market. That's up 23% year over year. 3 straight months. And Orange County is leading the pack. They have more homes coming on the market than any of the other counties, and at a much better, bigger pace than anybody else. And it far exceeds last year, the 5-year average. I haven't seen this kind of a pace. So a lot of Orange Countyans are placing their homes on the market. And so we're saying there's not enough homes on the market. We're actually putting them all on. They're just going into escrow really quick, which is why we have an elevated demand. Riverside County is at 4,317. They're up 9% year over year. It's only 2 months that they've been had the year over year gains as far as number of new for sale signs. And San Bernardino, 2,948. They're up 3% year over year. This is the first month that they did it. They were way negative and really late to the party. And San Diego's at 4,193, up 3%. They've only had 1 month of year-over-year gains. They actually had it 2 months ago, but month of August, they didn't have as many homes come on the market. They did in July, and then September, they did it again. They have as much. But I think that what I saw with LA and Orange County, they went back 3 months. They started off at like this 3% pace. So I think that these will continue to escalate as far as we have October and November is concerned, as far as the number of homes coming on the market compared to last year. So we'll just have to wait and see. So we just know a lot of homes are going to be coming on the market all the way up through Thanksgiving, especially this year. Number 2, luxury is outperforming the low end. And if you look at luxury closed sales, this is where luxury closed sales are. They're at an absolute staggering record level. I mean, off the charts. It is very hard to wrap your head around how incredibly strong it is. And for San Bernardino Riverside, it's $650,000 plus. Orange County, San Diego, it's $1,250,000 plus. And if this mix of homes in Orange County continues, they're going to join LA at $1,500,000 plus, because they're what I do is I look at the top 10% of a marketplace, and Orange County is quickly trying to join Los Angeles and might hit 1.5 million as the new threshold for luxury. So if you have a $1.4 million house in Orange County, it's going to be no longer luxury. You have to be at 1.5. So we're still analyzing it. We want to make sure it continues throughout the end of the year before we make any kind of a change. So as far as the rest of closed sales, all of closed sales, we are elevated. We beat all of last year right now. This is where we're at. We beat the year before in 2018, but we're at 2017 levels as far as closed sales are concerned. So we've done them before. It's not a record. It's a very high pace because 2017 was a rocking year, and this is beating it right now compared to what happened in these. Like June is always the biggest number. So let's look at luxury a little bit deeper. And you look, in September 2020, we're at 3,034 total luxury closed sales in Southern California. That was up 98% year over year, so almost double. That's the purple line to the green line. And August was at 2,704. This is up 56% at 2,704. And July at 2,409 is up 34%. But you can see how elevated it is incredible. 2020 is already a record year, and it's going to close out as a record year of the most luxury closed sales of all time for Southern California. And as far as the closed sales in September, low range, it was down 138 year over year. It was down 1%. Mid range, is up 2271. That was up 51% year over year. And the luxury range is up 1488. That's up 96%. So you can see that this is closed sales, how much more luxury closed sales we have. So it's the whole mix is completely changing. And the number one trend that I'm seeing right now is this. Demand remains elevated, and it's even heating up right now. I talked about October Housing Fest, and it has everything to do with these killer low interest rates. We've had 9 record lows this year, and we're knocking on the door of a 10th record if we get below that 2.86%. So we're right there. And it all has to do with these long-term bonds. They remain low, below 1%, and we're not going to see it go above 1% until we start to see the overall economy chugging along. And we're not going to really get there until we get past a big portion of this pandemic, and that's off in the distance. So, and as a result of these low interest rates, it's like, come here, come on, place your home on the market. It's luring everybody to come on the market, which is why we have an elevated pace of the number of homes coming on the market right now, is because everybody can read. And it's everywhere across the United States. It's on CNBC. It's all over the news networks, and everybody's talking about it. All publications have expressed what a great market the real estate market is, and is the best performing economic piece of the United States right now. Burning rubber. And you could see it with our elevated demand and where we're at right now and where it will continue until we get to, like I said, Thanksgiving. And it's been like a bidding war. It's out there. You've got a home priced below $1 million, and you price that according to its fair market value. That's always my key. You're very close to that fair market value. It is a bidding war, and then they bid against each other, and then the highest bidder wins. And oftentimes it goes for at the asking price, or oftentimes more. So let's talk real quick about the coronavirus. Just got a few slides. This is the world. It's going in the wrong direction, 36.7 million, and it's now averaging, we were plateaued right around 300,000 over here. Now we're at 320,000 is the 7-day average number of new infections every day. And I want to show you this. The European Union, they had their first wave, and then they opened up all their travel, and then after opening up their travel, they did this. They reinfected their country, and now they're in their second wave. This is for sure their second wave that everybody talked about in the fall. They've hit it, and they're right now averaging 52,000 cases per day on the last 7 days, and it's moving in the wrong direction. In the United States, you can see we're at 7.8 million cases right now and 47,000. So we're very close to where we've been crisscrossing back and forth, but we're headed the wrong direction as well. Because if you look back here, this was 26 days ago. This was an average of 32,000. We're now at 47,000, and the trajectory does not look good. It looks like we're beginning that same thing that the Euro nations were doing. And we're doing more testing. We actually hit 1 million tests within the last week, which is good. We were at 930,000 tests. They say we need to be at least 1 million, and based upon our positivity rate, we're at 5.9% positivity rate. 1 million's not cutting it. And remember when everybody was saying that? We need to do about 1.5. I heard somebody say 2 million. I was going, I think if we just do 1 million, but I was listening to the experts saying we need to do like 1.5 million. Well, they're right, because we need to get this positivity rate well below 5% in order to properly contact trace. The only way to do that is to get this testing up. As far as California is concerned, we've been in our best behavior. We're elevated, but we remain flat. We're not increasing. It's been the same now for the past month. California is at 823,000 cases, and we're averaging 3,300, which is up only 5 in the last week. So this has been pretty flat right now. So we're kind of maintaining where we're at, which shows this. This is the 7-day. This is the last 7 days over the prior 7 days. So it's just week over week looking at it. And you can see where there's a problem, and there's only a couple of states. I think it's Hawaii and, oh boy, I knew I was going to put myself on the spot. Someone's going to have to tell me. I just totally blanked on what that is. Mississippi? Oh gosh. I'm turning red now. Somebody can let me know on the stream which was the other green. But as far as unlocking everything is concerned, this was a week ago last Tuesday. We're at 6.4. cases per 100,000 and 3.6% positivity rate. We went to 7 and 3.4% positivity rate. So positivity rate improved, but this went the wrong direction. There were some counties that opened up, but it's pretty much central up. It wasn't anywhere near us. And this is where we're currently at right now. Orange County, for a hot minute, looked like we're going to go to orange. We're not. We're stuck. LA, they are in purple, this maroon color right now, and they'll remain purple. Orange County is going to remain in red. You need to have these colors go to a better color for 2 solid weeks before it moves on, and nobody's doing it. As a matter of fact, if you go the wrong direction, like Riverside, a week ago they went to red. Yes, that was awesome. And then they have 1 week of this burgundy color. If next week they have another burgundy color, they go back to burgundy, which means no longer in restaurant dining. They have to go outside again, because we're right now, red is at 25% in person. There's a whole bunch of rules. I've gone over them before. But San Bernardino is already in maroon. They're going to stay in maroon. And San Diego's in red. They're going to stay in red. So they need at least everybody's going to be in their present thing for another 3 weeks, except for Riverside. Was it Riverside? Is that what I said? Riverside, they might go the other direction. Depends upon what happens next Tuesday. Macroeconomic outlook, unemployment insurance, it's kind of flat. We have this it hasn't really changed much. It's flattening out now. I'd like to see more improvement. We're not seeing it. And this is at 840,000, actually went up slightly from the prior week. This came out yesterday. The Great Recession peak is 665,000 initial unemployment claims. Look at where we're at today, 840,000. You have to understand, this is kind of this weird metrics, because there's, with societies locking, unlocking, having problems, shutting down bars, reopening bars, all that stuff, it puts people on and off unemployment, and that's why this thing continues to be really elevated, and it will continue as long as we are dealing with this pandemic. So I don't foresee these numbers going down anytime soon, which will be a drag on the overall economy. As far as continuing claims for unemployment insurance, you can see the continuing claims is beginning to drop. We're at 11 million, so but that's still high, but it's going the right direction. And purchase applications, this is what we care about. It's not refinances, purchase applications. This will show us where's demand going in the future. It's up 21% year over year. It's actually been up now year over year for 20 weeks. I think it was negative for 5 weeks. Look at this, 20 weeks where we've had year over year gains. So you can see what the legs have looked like. And for a lot of those, I think it's 16 of them were double digit. So. And this is the rent payment tracker. You can see this is for the month of September. This is fully through the end of the month. You're going to read a lot of stuff because they just reported the week ending the 6th. They always report the 6th, and they talk about all the people that haven't been paying their rent. But that's actually kind of the story. Yes, there are more people that aren't paying their rent, but it's only slight. As a matter of fact, September, 90.1% paid their rent by the end of September. Where was it a year ago in September in 2019? 91.8%. So you could see it's off by another 1.7% down. So you could see there are more people not paying, but it's not nearly the giant collapse that so many people were anticipating. And I was really eager to see what October numbers were going to look like, because a lot of that the relief, the extra bonus unemployment checks are starting to dissipate, and we don't have that relief package, which won't come until probably after the election. So there's last one, mass exodus of retail stores. I do want you to see this. A lot of retail stores are shuttering up. There's a lot of online, which just requires warehouses and things like that. But we're seeing a major hit on the retail side of things. So that will manifest itself in the economy. It'll take longer for things to improve, things like that. Reportsonhousing.com, REPORTS on housing.com. And we're about to get to my the questions and answers section, so stay tuned for that. I have my cocktail of choice. Actually, it's just cranberry and something else. It's just a little hit of vodka. And so reportsonhousing.com. Head there, subscribe. You get a month free if you utilize the coupon code TRENDS. That's what we just went over, a whole bunch of trends. And there is a sample report section within the website, so you can see what we're all about. And I am going around to various offices by Zoom and associations. So if I'm not at your office and you'd like for me to be at, have your manager or somebody get in contact with me, and we'll book a date for to come out and do the forecast for 2021 for your county. And I've even done them for multiple counties for some offices. I'd like to just thank, again, Escrow Junction at escrowjunction.com. I did it quite. escrowjunction.com, 760-245-1966. They've been serving the high desert and surrounding areas since 1986. Adelanto, Apple Valley, Barstow, Hellendale, Hesperia, Oak Hills, Pedon Hills, Phelan, Victorville, and Wrightwood. There's a big difference to an independent escrow company like Escrow Junction. It's been around for a long time. They're independently owned and operated. They're not broker or title owned. They're truly a neutral third party. They have escrow license. They're escrow license and bonding required to operate. They have all that. They're regulated by the Department of Business Oversight and Department of Justice investigation. Photos, fingerprints required for all employees. Know that your funds are safe and secure with Escrow Junction. And they specialize in everything from sales to 1031 tax exchange, refinances, all these things. Just this great list. And they do have this wonderful magazine. Like I said, this is awesome. I absolutely love this thing. What a great idea, novel. So I'll put these different links so you can see what that looks like, and you can download your copy or request a copy. And now it is time for happy hour Q&A. So I'll move I think that's the best way to do it, I think.
Do you want me to put that closer to you?
I'm fine. I think I'll turn this slightly. Still has happy hour up. All right. Did a great president of University of Manheim Hills. We love your input at our office meeting on Tuesday. Sounds good. You want to change it?
Maybe tilt it.
So, anybody have a question? It's happy hour Q&A. I have my drink of choice. I hope you have yours. Happy Friday, everybody. You are welcome for this wonderful information. Glad I can bring it. As you can see, it's a passion of mine. So passionate, the closer my wife gets to me, the more you can see I didn't shave today. So, are there any questions? Were there any questions in the stream? I don't know. This is your opportunity. It's your happy hour Q&A. So ask away any question that you might have. I'd be more than happy to answer, and to the best of my knowledge, or I will punt it if I feel like it's not my lane. Are you concerned with all the inflation talk? I've talked about this before. I'm not a big... we've been running deficits for a very, very long time. And we have a really low Fed fund rate, and there's still an appetite for people to buy our bonds. So I don't really foresee inflation, although some people say that the inflation is in housing and things like that. I get it. You got to look at, they strip out all that stuff and look at what commodities are doing and things like that. So we're following all that, and I don't really foresee it getting way out of hand, and they're not going to be making a big change down the road if inflation even goes a little bit above 2%. But we're definitely not there. We've been running deficits for a super long time. Thank you, Stephen. Great news for market appreciation and knowledge. Let's see. Can you give us a snapshot of your 2021 forecast?
No.
You have to see it. We will be doing one of these down the road for the housing debrief. But yeah, I need to get into the offices and get the word out there. That way, the different counties, there are different strokes for different folks. Definitely, it's different for Los Angeles than it is for Orange County. It all has to do with the different numbers and what I'm seeing and the different trends. So it's kind of different for each one. So yeah, I've got to put it together, wrap it up for my whole Southern California forecast. I haven't really done that yet. I'm right now doing the county ones. We just started it up. Gosh, what was it? Beginning of this week. So I've been very busy getting those ready for all the different counties. We don't have it for all of Southern California combined. That will be down the road.
If they're interested, to contact me.
Yeah, if you're interested, contact me. You can just you can instant message me on Facebook and
To schedule
Yeah, to schedule one for your office or the association or what have you. And even if you can't book it, I had one agent that wanted it in their office so bad they went to their office manager and they go, okay, well, see what dates are available. And she actually contacted me. We put the whole thing together, and I never even dealt with the office manager once. Dealt with the agent that wanted it in her office. We're coming to a theater near Laguna Beach. I am seeing about 70% of my sellers leaving the state from down here in South Orange County. Is this happening everywhere? Yeah, that's... If everybody was leaving Southern California, we would have no demand. Yet, we have demand that is through the roof. And we have a lot of... And people say, well, these younger kids, they can't purchase at all. Well, you can do the math now. A lot of them don't even know that they can do 3% down financing, FHA. But that, in this market, it's very hard to put something like that together due to the fact that it's so busy. But we'll see what all those statistics are. We don't have any data on that yet. It's usually done through surveys, and it's done like a year later type of thing. So, but my go-to is I would like to see some people leaving the area just so that there'd be a little bit less demand. We don't have that right now. We just have, I actually don't like how hot the market presently is. I wish we had more inventory and demand a little bit softer, but I don't always get my way. I only like to see appreciation of about 3%. Just keep up with inflation, 2 to 3%. So will interest rates go negative? John, I do not believe interest rates will go negative. We haven't seen it. There hasn't been a need for it. The Fed's not a fan of it. I'm not a fan of it. There are some people that are, not my camp. I don't foresee it. And if it did, it would be for a blip, and it would just be a market, anomaly. I think it very much like what we saw. We'd have to have another problem on top of a pandemic for us to go that direction, and I just don't foresee that happening. But knock on wood, this is 2020. Who saw pandemic? Who had pandemic on for year 2020? Oh, we have a fireman. Holy cow. Come here, fireman. You have to say hello. Oh my gosh. He is. Come here. He doesn't want to. He's so shy. Don't you want to say hi really quick? Can I see you? Wait, can I see you really quick? Oh, you want to say hi to Nana? Nana? Here, let me see your axe. What do you have? You have a phone too? What is that? You have chocolate on your face? Look at this. We have a fireman. You could tell he went to Costco. Show him your axe. Oh, he has a whistle too. And he has a cell phone, because all good firemen.
No, but he has this radio thing that he's been talking
about.
Oh,
this is a radio, okay. You need to tell anybody anything? Oh, good, thank you. That is awesome. How fun. Let's see. Will interest rates go negative? I don't believe they will. So question, can you elaborate on the demand? Oh, I need more of that one. My love, Steve O'Rude. Can you elaborate on the demand for fixers versus turnkey versus clean but not updated homes, specifically condos?
If possible, thank you.
Yeah, there are in most areas. There's a few exceptions. San Diego has a lot of exceptions, and Orange County too. That lower price range, that 5 to 750. But there's still a lot of homes that have been on the market for 60 days plus, and that is because there's a difference between their fixers as well as turnkey versus clean but not updated homes. So people have a problem with pricing their homes based upon where their condition, upgrades, location, and all that are concerned. And usually when somebody tells me that their house is not sold, regardless of what area it is, there's always this underlying reason as to why it doesn't sell. So, and I look at that. So there's a lot of demand for fixers, and there's a demand for turnkeys as well, because there's fixers. There's always people looking for some kind of a deal where they can go in, they can purchase it, but it better be priced like a fixer so they can turn around, gut the whole thing, redo it, and place the home on the market. There's demand for them because there aren't that many, and there's a lot of investors that are competing for that kind of a product. Then you have the turnkey, the stuff that looks like a model. Those are the things that sell the fastest, and when they price according to their fair market value, they'll get so much activity that they oftentimes sell for even more than their asking price. And then you have your clean but not updated homes. Those look really nice, but they, you know what, it still needs like new cabinets. It needs a new kitchen. It needs new bathrooms. And it's very hard to price those because there's a lot of people that go in there and they go, gosh, I just don't want to do this. They have a hard time visualizing what needs to take place. That's thanks to Joe and Chip and Fixer-Upper stuff and all the countless number of channels that are out there. They have a problem. Now, all buyers and everybody, myself included, everybody, we have a hard time visualizing what it would take because we think it's just going to be too cost prohibitive. It's going to take a long time. It's such a pain in the behind. We'd rather have it done, and people are paying a premium for it being done. And if it's not, it doesn't look like a model and ready to go and everything being updated, it better be priced accordingly. So it's very, very, that's why it has to be an expert in pricing. And those little algorithm websites you can go to figure out what the value is of your home, that's just an approximation. That's just a guide. That is definitely not the value of your home. Yes, Stephen, okay, Century 21. Yes, how about the stock market? How about the stock market? I'll let Logan talk about the stock market. So I'm not really that concerned about the stock market. A lot of it has been reallocated towards what benefits in the current economy that we're in, as well as there will be a fluctuation. If we ended up getting a change in the presidential administration, you're going to see this whipsaw effect. It's not going to affect housing, but it would affect the stock market. That's because people will be pulling their money out of, like, let's say, for an example, oil stocks into renewable energy stocks. And because we're going to be that's the difference in what their platforms are. So that's where you see this sell and then you see this buy, and then in the long run everything kind of works out. So that's my take on the stock market. I watch it. I listen to people that are way smarter than me about it, and I'll let them do the discussing of the stock market. A lot of buyers are coming from the big cities. Yeah. And that is a phenomenon that's just going to go on right now because we're in the midst of a pandemic. People don't like to be in very, very dense areas. As we can see, that's where they have the biggest problems, or where it's their most density. And that's even where we've had the problems in and throughout Southern California. So when you have that, the people they want to leave. And so it's not this mass exodus that's going to be permanent. It's a temporary thing. So this is one of those things where if you see values going down in certain areas, like let's say New York City, that might be an opportunity to jump in while values are lower, because long term I think that they will be just fine. When foreclosure is allowed to happen? Well, it's looking like the earliest that they'll be able to start anything is not until 2021. So this is a 2021 story, and it's not until the second half of 2021 when we really get going, and it's not going to be a big story. I've talked about it before that we're not going to get a wave of foreclosures and distress. A lot of that, the forbearance right now shows as distressed, and it's I believe it's right at 3.4 million right now that are in forbearance, and it was at 4.3 million. And so it's been coming down quite a bit. And also there are 1 million that aren't in forbearance that are behind. So when you look at it, that sounds like a lot, right? But out of the 3.4 million that are in forbearance, 90% of them have at least 10% equity that they can go ahead and tap into in order to sell their houses. So I'm not really that worried about it. Now when you look at 10%, and they're not all going to be foreclosed on or have to do a short sale, 10% now is looking more like 340,000 across the United States. And when you dissect it across the United States, it's, yes, we're going to see an elevation, but we're elevating from, let's say, 100 in an area to 200. And when you're talking all of Los Angeles County, you're not going to notice any of that. So there's not going to be that wave. So I really wouldn't worry too much about a foreclosure wave. The market is too hot given the low interest rates. I'm right now at where Zeke came on. When foreclosure is allowed to happen, I think I answered that. What do you see happening to high rises in San Diego? It's kind of like that same story that I talked about. They have the same problem in Los Angeles. They have it in New York. They have it all over the place in the big cities, and that's because people don't want to. And you also learn something else. When we're very mobile and we're able to go out and do a whole lot of stuff, which is not right now, that is when living in a high rise is like a really cool thing to do. Right now, when you're stuck more in your dwelling, and you can't go to the common areas and things like that are closed down, it really makes things a little more confining. So more people place their homes on the market. There's not as big of an appetite. So that's only a temporary issue. There's more of a supply glut there. There could be an erosion of prices within that small segment. And like I said, I'd wait until right around the time where we're mid-vaccine, that they'll probably hit their lowest, and then that's when to get them, because I foresee them continuing to go up like the rest of housing. Because there's a really good demographic patch that is coming online every year for the next 4 years. Ask Logan Motoshami about it. He talks about that a lot. It's good information. Let's see, where am I at? I have is watching. I think I'm at the top. Hey, 3:55. Are there any more questions out there? Cheers to everybody. Because if not, we'll just have to wrap this up, and I'll have to enjoy my weekend. So that's what we'll do. So if you have any other questions, you can put them in the thread. I'll be more than happy to answer them after this. I continue to, and I just appreciate you being here, and appreciate Housing Debrief episode 46, I believe. And thank you for staying tuned. And we'll see you in another week, and we will not have a happy hour Q&A at that time. But have a beautiful weekend. Enjoy it. It feels like fall. I heard next weekend's supposed to be hot, so enjoy this nice fall weekend. Thank you very much, and have a super fantastic weekend.